We're back now with Ryan Lewenza. He's our featured guest of the morning for a look at why he's constructive on U.S. small cap stocks, right?
Yeah, so this is one area in particular. We're pretty bulled up for next year. There's a lot going for this area. Number one, Fed cuts. We've been talking about this. This helps smaller companies. They have a lot of debt, variable debt, so it will lower their interest expense. It'll help profits. I think Trump's policies could actually help small cap. If he's cutting corporate taxes, deregulations, this helps smaller companies. Even tariffs help smaller companies because they're more domestically based, right? It's a multinational. It's Ford who has to buy products from us here in Canada that's going to get more impacted. We have a bit of a catch-up trade. Small caps have only returned 8% over the last decade. Large caps 13%. That's kind of atypical. Usually small caps over the long term do a little bit better. And now we've got kind of my fourth point here, which is valuations. They're cheap, right? I just talked about in the earlier segment that the S&P is expensive. So what we're looking at here is the price to book.
Price to book, okay.
So I'm going to talk about two metrics. One, price to book. Right now, the Russell 2000, the main small caps, only trading at 2 times. The S&P is 5 times price to book. You can see back in 2010, they were around the same level. When we look at earnings, right now the small caps are trading at 17 times versus 24 for the S&P. And then finally, we've got technicals. We've got a new breakout. So I've got economic support. I've got valuation support. I think this is going to be an area that does well next year.
It's been 14 years since the price-to-book ratios were similar. How far can that gap close in 2025?
And it won't go back to parity. Right. You know, a big reason for the big price-to-book is technology, right? The S&P has a huge price-to-book relative to a lot of other geographies and markets, and it's because of a big tech weighting within that sector. So by no means am I saying they're going to go back and converge, but even if they converge by 1 point, if the price to book goes to 3, boy, that's big upside. So I just think it's got a lot of supports for it. Thankfully, we added 3 or 4 days before the election. We got a little lucky on this. We added to small cap, and then our ETF was up 5-6% on the day. And now everybody's talking about small cap. We've been in this trade for the last year. I wouldn't be surprised if we start seeing more fund flows. So for us, this is a good setup here going into next year.
You watch technicals as well. How does the small cap index look from a technical point of view?
So they're simply on a price basis. So I'm IWM, that's a big US ETF. That just made a new high. So that's one very positive technical. Obviously, new highs is good. The other thing we look at is relative strength. So we compare small caps to large caps, right? If I'm saying small caps going to outperform, we got to see it in the charts. We're not quite seeing that yet, meaning the S&P is still outperforming on a relative basis. But if I'm right on my call, that's going to turn around quickly. And so we think we'll start seeing that relative outperformance into next year.
What's your view on the other side of the market cap spectrum, the mega cap tech stocks? Is your view on the small caps predicated in part on a rotation out of those names?
A little bit. So there are these Magnificent 7 or Magnificent 10s, lots of research coming out. The valuations are very, very high there. And one day, this is going to end. I've seen this story before. Yeah. We're now seeing PEs of 30, 40, 50 times. I just looked at Tesla was 140. One day this is going to pop, but as long as the earnings, right, as long as NVIDIA, right, front and center, as long as they continue to chug out phenomenal earnings growth, then these elevated valuations can stay up there. But it's when NVIDIA comes out and says, boy, our sales are decelerating. When these large caps start saying, we're not growing at 40, we're growing at 35, that multiple can compress quickly. I don't think that's a 2025 risk. I think that's more of a 2026 risk. But back to your point, it's part of that. It's those real high valuations. So let's find other areas of the market where there's better value. And if we're right on the broader markets, that the cheaper value might get us more performance.